Forex.Today, Wait, is there an echo? Good morning, welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Today we have CPI. As Jay Powell has already said, inflation for goods seems to be falling, but not for services. Huh? When is Supercuts going to cut their price? Remember when Supercuts was like $5? Now it's what, $20? When are they going to cut it back to 15? COVID's over, yo. Yeah, that ain't happening. When's inflation going to come down, huh? When is that artificial intelligence programmer going to want to take a pay cut? Hey, Wall Street taking a pay cut. Why can't Silicon Valley take a pay cut? I don't know. So anyway, things are sticky. And of course, the biggest thing, 30% of the CPI is rent and rent equivalent. And unless the housing market comes down, we're not going to have inflation fall. So it would be a very interesting and probably very much misunderstood CPI today. So get ready for volatility and remind yourself volatility is bad. Now maybe you'll get a skippy scalp out of it and pick up some pips. Okay? But it's kind of like running through no man's land sometimes, so be careful. You might get shot. It doesn't even matter if it's bulls or bears. You might just run into the bullets. You might just be in the way. So what I recommended days ago was decide what you want to do in the foreign exchange market. Are you a bull on euro? Are you a bull on dollar? Are you a bear on euro? Are you a bear on dollar? That kind of thing. And look at the currency pairs you want to engage in. The thing is, if you're a seller, you want to engage high. If you're a buyer, you want to engage low. And try to catch the peak or trough of the vol. Trade it in the direction you want to trade. You know, so whatever. Don't chase is all I'm saying. But yeah, you do you. I'm not your mama. I'm not your papa. You do you. And then we can talk, we can try to dissect CPI and see how the market interprets it. Does that mean the Fed is going to pause? Does it mean the Fed is going to hike and stop hiking or never pause or cut? There's so much going on. So thank you for being here today to do this with me. With all that being said, let me remind you that trading is risky and not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne. I will be your guide on this CPI journey. I've been trading for, let's say I've been in finance for almost 30 years now. Yeah, that's pretty amazing actually. 20 of that being specifically foreign exchange. Very cool. Over those years of experience, I've learned a few things about trading. I've learned many ways of not doing it right and a few ways of doing it better. I've also learned macroeconomics. I've learned monetary policy and strategy. I've learned how the markets work, which is different from the economy. So that's, so cool. So why don't you ask some questions? I'm happy to share. Make sure you click the thumbs up button, tell YouTube that this is quality content and this is exactly what you're looking for. I'm not going to give you a rah-rah speech on how to get rich quick, how to buy a yellow Lamborghini, how to get girls in bikinis. Look at me, I'm flying in my jet. No, that you're not going to get that from me. So if you are looking for any of that, go find some kid on YouTube. Cool. Anywho, ask questions and I will do my best to share. In the description below the video, there's a link to my book. You don't have to buy it, don't worry about it. But if you did, would you leave a review? For some, reading is not their modality. Videos might be your modality. Cool. So there's 88 hours of videos at FX Bootcamp. So there's a way for you to get some help using your modality. For others, they don't like reading, they don't like watching videos. They like to be shown how to do it. Just show me how it's done, Wayne. Well, then we have live communities for that, for live training. Cool, there's your modality. Lastly, I recommend Trader's Way as your foreign exchange broker. Why don't you check them out? They earn my loyalty and respect, not through banner ads, but by their performance in the real world when many, in fact, several very, very large foreign exchange brokers were tested in a black swan event. And the analogy is think about when the tide goes out, you get to see who's naked, who's been swimming naked. Well, there were foreign exchange brokers out there that were promising you non-dealing desk, straight through processing. Then a black swan event happened, and for some reason they were holding the other sides of the trade. Like, wait, you told us there wasn't a dealing desk. Oops, maybe there was a dealing desk. Maybe the broker was trading against their clients. And we learned that during that black swan event, but we also learned Trader's Way was perfectly, absolutely, completely fine and safe. Looked like it to me that they were not trading against their clients. So if you like that, cool. Try tradersway.com and see if they can earn your loyalty and respect. If they earn your trust, open up an account. Okay? Don't worry, you don't have to click the link if you don't want to. You don't have to put in my name so I earn a commission. It don't work that way. Okay, we got CPI coming out in a couple. Let me get in there. I look 20 years younger? Really? Why? That's weird. You're fooling me. You're fooling with me. You're joshing. If you have the numbers, go ahead and post it in the chat. I'm much more interested in the subcomponent stuff because I've tried to figure out the rest of the year, not the rest of the day. My primary concern is the rest of the year. If I met with a client in a month and a half from now, or a few weeks from now, or a few days from now, they might ask me, so what do you think about this pesky inflation stuff? When is it going to end? And what do you think the Fed's going to do? I have to think more about the headline, you know? Oh yeah, happy Valentine's Day to those that have hearts. I'm heartless. I'm a Grinch. I'm the kind of person when you see a woman with a new baby, I said, oh my God, does your husband know? If somebody shows me their new puppy, like, look at my puppy, I'm like, oh my God, is it sick? What's wrong with it? Heartless. There we go. Let's take a look. Okay. 0.5. 6.4. Seems about right. Thank you, Henry. The index for shelter was by far the largest contributor. Okay, rent. Rent. Oh my gosh, right there. Rent. We told you. Half of the monthly increase, yeah. Indices for food, gasoline, and nat gas also contributing. Remember, I think these things were part of the recent decline in CPI. I look at this as a bad report. So what they're saying is food and gas and other forms of energy are rising. But see, they've been falling. If that continues, inflation's going up again. And boy, we talked about that, in my January overview of the year, that could very well happen in the second half, that CPI is actually rising. The headline CPI. Oh, la la. So how about that? Send you a link? Yeah, sure. Sure, fine. Yeah. By the way, members of FX Bootcamp were given a challenge yesterday to read the old CPI data. To be ready I posted a link for a review, and then I think I did retail sales, sorry. But we have a new feature at FX Bootcamp. Dude, listen to my voice. I didn't sleep enough last night. I haven't been smoking cigars since Sunday. What day is it today? Tuesday? So it ain't that. Me. But look at the dollar tank. So I guess the market sees this as good? Huh. Okay. Looks like up, but I guess the market's what? Okay, the 12-month percentage change. Okay. Only core is slightly, I don't know. I don't read it as that great. But the market's loving it. Massive risk on. Excuse me. Hang on, I want to check something behind me. Yeah, we made a tick lower on the Mexican peso, which I re-entered about 24 hours ago. So that's good. Gee whiz. Maybe I need a cigar. All right, so let's take a look. Let me. See, I want to use the highlighter, but I guess I can only draw. What I was going to try to do is use cars and trucks. So hard to do this. All right. So used cars and trucks are down 11% year over year. All right, but flying on an airplane is still 15% higher. Rent is still 8% higher. New cars are still 6% higher. Heating and cooling your house is 27% higher. Look at that, 27.7 for energy services, I guess, right? Is that right, or is that fuel oil? Let's do all energy services. Okay, 15% more for your electric bill. Gasoline slightly higher, but fuel oil higher. Food, right? You guys like to eat? 10% higher. So it looks like the things we care about are 10% higher. Okay, 15% higher. Oh, but if you want to buy a used car, it's only 30% higher than it used to be, not 40% higher than it used to be. See, that doesn't mean, right, back to where it was. It could still be significantly higher than normal. So I don't know. Rent is still high. These are the things that we're kind of looking at, right? See, it says shelter as a service. Isn't that strange? Your house, if you own your house, it goes there. Because if you think about it, if you rented an apartment, somebody is providing you a service because they own the building, and the service they provide to you is shelter. But also you could look at the house you own. You own an asset that's performing a service, shelter. So there's something called owner equivalent. It's like if you were to rent your house, what rent would you be paying? And so that's how that goes in shelter. And well, it's still higher than it used to be. And of course, flying on an airplane is very high. My plan this year was to take the family to Japan. And once COVID restrictions were released, we looked at the tickets to Japan, and it was 150% higher. More than double. And I'm like, kids, no samurai swords this year. So 15, we're still looking at like, it's expensive. There's less planes, there's less pilots, there's less flights. Excuse me. All right. But that whole food thing, okay, commodities, man. Looks like it's for poultry or meats in general. Of course, we all know about the egg crisis. About 3 weeks ago, we ordered food from the grocery store, and they delivered 3 dozen eggs. So we called them, we're like, we didn't order any eggs. You sent us 3 dozen. Actually, it might have been more than that. It was like the 3 cartons of 18 eggs, I believe. So whatever that adds up to. We contacted the store and they're like, this isn't our stuff. And they're like, keep it, throw it away. We don't care. So we gave them to a family that needed them. There's no way my family can eat that many eggs. So yeah, we gave them to somebody. All right. So anyways, food. So huge. Those eggs are expensive. Cereals, bakeries, cereals up 1%. Beverages, non-alcoholic beverages increased 0.4%. Pepsi reported today. Did you see they have 23% profit margins? So when you buy a can of Pepsi for 25 cents, 10%, 10 cents of it is profit. Like, oh my God. So anyways, okay. Energy rose 2% in January. Gasoline increased 2.4%. I think this stuff is probably going to keep rising. The way I look at it is headline CPI has come down quite a bit recently. But I believe it's not natural. It's artificial. And the process that was used to drive down headline inflation by dropping gasoline specifically cannot continue and is not continuing. We have not pulled from the Strategic Petroleum Reserve in, I think, 3 weeks. And now we're already seeing gasoline prices going back up. So we can report, hey, gasoline prices came down, please re-elect me. Now, I'm not being political. This actually happened. So 6 months up until the elections in November, we drew down the Strategic Petroleum Reserve by 200 million barrels of oil. We added them to the market. Okay, it wasn't like we just drilled it out of the ground and sold it to the market. We had this stuff in storage for years and years and years. So the 6 months up until the election, oil and gasoline prices were through the roof because of Russia. So we added that artificial supply. Gasoline prices dropped by 50% and boom. Okay. Election turned out positive. It's a smart strategic move. And now that the election's over, guess what? Gasoline prices are going up again. And that might just continue because the process of drawing it down from $4 to $2, well, that process is likely over. Okay. Jim says we got more on the way. Okay. Yeah. So there you go. We're down to only 200 million. And also, I don't think you can actually draw down the Strategic Petroleum Reserve to zero. I think what happens is the caves collapse on themselves. So you can only do so much. And I think we're pretty close to, I don't know. Maybe we shouldn't be tapping some of this stuff. Anyways. See, people will tell you that inflation is falling. Is that correct? Is inflation falling? See, last year we had 10% inflation. Now we have 5.6% higher prices than last year, and last year was up 10%. Prices are still rising. Okay, so very often it's misreported where inflation's falling. No, the rate in which prices are going up might be slowing, but if you were shocked at last year's prices, well, you're paying 5% more or almost 6% more this year than last year. So anywho, fuel oil rose 27%. Wow. Electricity rose 12%. Even that doesn't even seem right. Nat gas up 26%. How is that? Anyways. Oh, wow. Anywho, the market seems to be reacting positively. I guess why? A lower headline number? Like they thought it would be higher than 6.4? Anywho, let's go take a look around the world. Let's do the stock markets and see how they're responding. We'll start by looking at the S&P 500. So what did I say to you before the news? If you're a bear, find a place to sell high. If you're a bull, find your place to buy low. Use the volatility to get into your fundamental bias. Okay? Now, looking at this setup, you may recognize this. Let me change this to a marker from highlighter. Okay, boom. This area here, you may recall, is plan A for bears to sell if there's technical confirmation of a rollover. Do we get it? Niet. The second part was plan B is up in here. Okay. So the way I see it, this is bulls buying a dip. Now, why they review it as bullish, I'm not sure. Okay. Up here is where bears would sell. Because remember, I only allow you, if you're a bear, to sell lower highs, but that didn't work, so forget that, or tops, and this would be a triple top. Okay. And what happened? Remember, I just gave you that analogy a half an hour ago, less than a half an hour ago. I said it's like running through no man's land, and you can get shot by either side. So how do you stay in the trench? Bullish trenches are down here. Bearish trenches are up here. And everybody that's trading in the middle here has a wonderful opportunity to get shot. And when you get shot, do you care whose bullet it is? That's probably not your first prime concern. Was it Billy or was it Johnny? Doesn't matter. The bullet, you got the bullet in your belly. So anyway, so that's nomad's land. You're getting just destroyed. And it doesn't really matter if it's bulls or bears. You're caught in the middle. Bullets is bullets. Bullet the blue sky, oh. Bullet the blue, and you run into the arms of America. Taking a look at Australia, oh la la. Okay, there's our setup from yesterday as a sell. Retest today. You probably got close to your stop. 2 shakes of a lamb's tail. It's sort of like narrowly avoiding Mike Tyson's uppercut. You're like, whoa! Oh, man, those old Mike Tyson fights. Oh, the 90s were so good, everybody. We were changing the world, developing something called the internet and email. But, oh, watching Tyson fights, people were so mad one time. People were paying like $500 for the pay-per-view. People were still in the kitchen getting their snacks, and boom, it's over. They're like, what? What? It's over? What? And Mike Tyson would get low, and he'd go left to the kidneys, right to the kidneys, left to the kidneys, right to the kidneys, left to the kidneys, right to the kidneys, right uppercut. So he'd go wham, wham with the right hand, 2 shots with the right hand. But by then your ribs were breaking, your legs are going weak, your kidneys were collapsing, and all of a sudden, snap, your neck was broken. And it was just like, because you're so hunkered over, because your gut was on fire, and all of a sudden, snap, your neck's broken. And then while you were falling, he'd hit you again right on the chin. Now your jaw is broken, your neck is broken, and you haven't taken a breath in about 15 seconds. But your organs are bruised. And it was over. Yeah. So anyways, it was so funny to watch too. You felt bad for the other guy because like literally there's one guy, if you watch all the fights, he's completely unconscious. He's on the ropes, but he's falling. He's falling. He's lights out. And all of a sudden, whack, he gets hit one more time on the jaw. You're like, stay down, brother, stay down. So anywho, you want to narrowly avoid getting punched in the jaw. That uppercut always got you. And it was always right to the kidney, right to the chin. And then lights up. Oh, made it as against boxing? Yeah. In Canada, we call it the WHL. That's how you play hockey. I've been to hockey games in the Western Hockey League where not only are there fights on the ice, but there's fights in the audience. I'm not even joking. Anyway, so look. This is what this is set up for, and that the trade is trying to survive. And if you're doing statistical analysis, you're looking at there's the slope of the mean, 1 standard deviation, one above, 1 standard deviation below, and this is an outlier to the trend. And what you might be doing now is trying to get a resumption of trend. Yeah, I suppose, Maida, the difference is, A, gladiators were slaves, and B, do you really feel bad for the guy that signs up to fight Mike Tyson and gets paid $12 million? Yeah, it's a little different. Hey, man, if the guy... Get in the ring. I'll pay you $12 million. Okay. Okay, I don't know. So I got you. I know what you're saying. The slavery of money. Yeah, I feel the same way if I see Love Island on TV. I'm like, what? These guys are doing it for love, or are they doing it for money? Hey, women are just as bad. They do it in their own way. Yeah, Damon. Yeah, well, I'm trying to. Before we get to the end pairs, obviously, Damani, you want to see the overall direction the market wants to go. So bulls bought off the bottom for the S&P 500. So we're okay there, but we're just back to where we were. So there isn't a clear direction. Okay? So, but Damani, what this shows is, well, I look. How about this? Okay, how about this? I look at this and I see US dollar. So maybe that part is not clear. So, okay, fine. We can look at this one. Oh, this is remnants of an old trade. I should be careful on this one. What do I want to do with this one? Okay, this was an old sell high scenario. Check it out on a daily. Yeah, but it's not great. I think I'll protect myself. Throw it down there. Okay, fine, cool. So what do you think? Well, if I thought this way, this could be my strategic plan for the next several weeks. Okay? So in the short run, and now I really have to zoom, I had two choices. And it looks like the second choice would have been the better one, but whatever, it's hindsight. Now, I have to set this up. How would I explain this? I guess price action versus moving averages. They're kind of end up being the same, but one is a little bit before the other, so it's a little aggressive. So the idea here is a price action type play. Well, let's start with the moving average one. Okay? Up to the moving average and sell it, which I did. Okay? Cool. And remember when I did it, we were down here. So this moving average was slightly lower when I did the plan. And then I was guesstimating where it would be in the future. So the idea was up this way. Okay, great. So I'm not terribly wrong. I'm just not right, but it's in the slot sort of thing. Now, that's that. So I'm using the moving average as resistance and not support. Okay. Cool. So the next one would be moving average, price action. And what I would do is I would take this zone. So we can call that a 50. And of course, the most aggressive here would be the 382. And you can see that's actually where my stop is currently. So at some point I'll jam my stop. So if we go up there, I'll get out at break even or a small loss. Let's say we get this today. But by Thursday or Friday, we're up here. well, then I'll look for a rollover and then I will sell it. Potentially for weeks and weeks and weeks and weeks. So I'm going to now launch my super secret fundamentally based alert service on March 1st, which is a Wednesday. I've moved the date. I'll plan that out. But one of my goals of that presentation is to show you how to have confidence from data to know when to let your winners run. So you could say, like before this news event came out, what I told you is set up the trade you want. You don't know what the market's going to react to or how it's going to react. But if you're a bear, look up on high. See if the volatility will put you in a good trade. Now you have to ask yourself, do you think 108 is reasonable resistance if you're already a bear? And you're like, well, that's pretty close to a 382 Fibonacci retracement from peak to trough to lower high. Yeah, that might have been enough. So now you might have your stop jammed at break even. Good. But the thing is, are you going to be short and make this amount, which is 50 pips? Or are you going to be short for 500 pips? It looks like the same trade. Although what you might have done is bought this dip and then now you're, whatever. If you're going to buy it, that's actually the entry. But nonetheless, knowing in advance when, where, why, and how to let them run, I think is key. Key. Okay, Piggy came all the way back. Okay, and are we in the zone? Now we're all clustered up in this. So I got to go to a higher time frame and see if there's any clarity. And of course, obviously, what happens next is critically important. Okay, yesterday we talked about this. So let me bring it up again. Okay, if you're a bear, there are two prices in which you would sell. This is one, and this is one. But you only sell when you're rising. Okay. Now, I think a boot camper posted this for feedback at FX Bootcamp in our new community feature. And I said, well, be careful. Is it actually trending or is it ranging? So this one is a little spooky because it's based on a trend that may not actually exist yet. Now, you might get lucky and it might work out, right? But what this chart actually says is this is the next sell again. We have to reset the whole thing. I hope it doesn't work that way, and that's why I have this set up. But that's the weakness of this setup, that it's a trend trade in a range market. Yeah, well, that's the whole thing, right, made up? That's the tricky part. Sometimes you cut the corner and say, well, you believe this is going to break out to the downside and develop a bearish trend. But what I teach is something quite different, isn't it? What I teach is if this is range bound, it's going to stay range bound forever. Forever and ever 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 until it breaks. So you would actually try to avoid an entry here, But sometimes it's okay if you get the setup, you take the shot, you drop a stop, and maybe not the greatest trade in the world, but sometimes, it's just an opportunity. Okay? Now, if you thought this was coming down for fundamental reasons, then you probably would be thinking forward, and you're like, okay, it's going to fall at some point. So, you have this area to sell, and you have this area to sell. And there is no other area. Right, Maida? So you're like, well, you can ignore this. But then if it fell, you're like, man, I should have taken it. You remember, the ones you don't take always work out, right? So anyway, so the second one is here. Do you really want to triple top? Or if you only have two choices, right? Lower high, lower low. Or triple top. The triple top's more conservative, obviously. But maybe the other one's worth a shot. Especially if you can get out at break even. If you take the trade and you can manage the risk, lower the risk, and then remove the risk, yeah, maybe it's worth a shot, right? Again, using sports as the analogy, my coaches always told me, you can't score if you don't shoot. Okay? Sure know what I'm talking about? So, but you don't want to take bad shots either. Like, when you watch NBA regular season games and you see some guy from 5 feet behind the three-point line, he takes a shot. I'm like, what? Dude, pass the ball. Come on. So there's stupid shots. But other times, you gotta take the shot. So anyways, I don't know. Okay, so anyways, we're still farting around here. So a couple of things. As we talked about yesterday, we have now been officially told that we have a new person in charge of the Bank of Japan. Okay, so you got some yen reaction to that. And the other thing I wanted to talk about is sort of like politics a little bit. Brainerd, a year ago, was the president of a regional Fed bank. Then she was nominated and appointed vice chair of the Board of Governors of the Federal Reserve Bank of the United States. And now she's leaving the Board of Governors to join the Council of Economic Advisors to the President of the United States and his cabinet. That's a heck of a 18-month role. I mean, that's really some LinkedIn profile candy. Oh, I was the head of a Fed bank. Then I was the second in command of the Board of Governors. Now I advise the White House directly about economics. And guess what I think is actually happening? I can smell the fertilizer in the roses, so to speak. I think what's going down is Janet Yellen doesn't want a second term. I think Biden might have sat down and said, Janet Yellen, JY, I'm going to run for a second term. And she's like, I'm out. And so I think Brainerd is now going to be on the Council of Economic Advisors to the White House. And in 2 years, she'll be Secretary of the Treasury. And boy, does she know how to play the game. So some whoop, whoop, whoop to Leonard. Leonard Brainerd. Lael Brainerd. Whoop, whoop to LB. She's got some skills. And I think more politics than I don't know about economics. I know she's qualified, but boy, if you could throw all those moves down in a like 2 to 3 year period, right? Head of a Fed bank, second in command of the Fed, okay, major contributor to the Council of Economic Advisors, and then Secretary of the Treasury, all in 3 years? You're like, dude, shut the back door. Yeah. Okay. Jimmy says, I'm hearing the new guy may end YCC. This is a speculation. No, I don't know. And what I read actually is that this guy, what's his name? Uebe? He's been around, but sort of like behind closed doors type of advisor. So you don't know what he actually said, but he was around for all the important meetings over the last 5 to 10 years when it came to the Bank of Japan. So like quantitative easing, yep. YCC, yep. All that kind of stuff, yep. Do you remember when we had the Prime Minister, the upper parliament, lower parliament, and the Bank of Japan all committed to ending deflation? I think this guy, Uebe, was all part of that, but again, preferred to not be in the spotlight. So, like, I guess, Jim, I don't know yet. So I remember when Ben Bernanke was nominated and looked like he would become the head of the Board of Governors, I immediately went to, I think I had to go to Stanford University. Because remember, Amazon at the time, Amazon.com, was a bookstore, nothing else, but they only had sort of like popular reads and some other stuff. But I couldn't get like Ben Bernanke's papers from Princeton. So I went to the Stanford Library, the Stanford University bookstore, and was able to order these books. And so I bought his books and I read them, because I wanted to know who this Ben Bernanke guy was going to be. And then I'm like, ooh, this guy's specialty is in the Great Depression. I'm like, why would the Fed put a depression guy in charge of this? And I'm like, huh. But I got some of his books are probably right over here. I got boxes of books. I need to sell all these books. Just seeing if one happens to jump out. Yeah, right here, actually. See? I know you think I'm full of crap. Oh, that Wayne, he's full of crap. Look, right here. Boom, The Great Depression by Ben Bernanke. Cool. It's coming. It's coming. Okay. So anyway, I just, it's good. Okay. It's good reading. Cumulative log changes in M1 over the base. M1 being part of the money supply. And you can get all of that. So imagine 20 years ago reading about base changes on M1, reading some fine reads, Now check this out. 20 years ago, okay, this is Ben Bernanke's chapter or paper on the cyclical behavior of industrial labor markets. Now, who also contributed? What? James Powell? Oh, who? That's right. Richard's right. He's a MIT guy. Yeah, PhD, I think, from MIT. But anyway, so imagine doing that kind of research 20 years ago. And you're like, so I don't know if it helped, but it maybe helps me today have a slightly clearer understanding of what's going on today from what I learned in my research 20 years ago, from what Ben Bernanke learned 30 years before that and published. So now we got 50, 60 years worth of data. Anyways, right? Don't get me going on the IS curves, man. All right. So anywho, yeah. So Jim, I'm open-minded to learning, but yes, probably time to get rid of YCC. Yeah. Which means yields in Japan might skyrocket. Right now, they're not. Okay, so that could change. So we had a trend in place. Then the trend has done its role reversal. So look at this. Okay, top, 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 top. So you got to mark that. Then you got to mark the neckline, 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 neckline. So you got that range. And then you had the lower low, lower high, sell. Lower low, lower high, sell. It's all valid. Lower low, lower high, sell. Lower low, lower high, sell, loss. Are you okay with that? Sometimes what people get so consumed with is like, oh my God, but now we're up here and you should have known that. Okay. You could have had 2 or 3 or more good trades in a row. The last one didn't work. You're out and now you're waiting. If you're a bull, this is an easy buy. Question is, I don't know if you're a bull or a bear. The way I want you to trade is you tell me, Wayne, I'm a bear on QE yen. And I'm like, why? And you go, wah, 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 wah. And I'm like, okay, cool, whatever. At least you spit something out like you believe by April 1st, the yen will be significantly stronger. And I'm like, why April 1st? And you're like, oh, well, there'll be a changing of the guard of the Bank of Japan, and there will be an end to yield curve control. And blah, blah, blah. Okay, great. So you're like, so for the next 6 to 12 months, you prefer buying yen, even if it's unseasonal. I'm like, okay. But remember, it will become seasonal. Like, guys, I've already talked about this 3 months ago, and even 6 months ago to some degree. But there is seasonality coming where even if none of this makes sense, it will look like it makes sense. So therefore, it's real, I guess. But the yen is going to get strong. And then people on TV are going to say, oh, it's the new guy. No, well, maybe. And then when he does announce yield curve control, the end of yield curve control, and if yields rise and that changes the flow of capital, oh, that'll make a strong yen, but it's already supposed to happen. I already know the future. It's very helpful. That's why we look at seasonality. So anyways, you can filter all this out. And instead of trying to be right, because I think some of you are still like, I want to buy here, and then I want to get out here, and then I want to sell it, and then I want to buy it, and then I want to sell it, and then I want to buy it, and then I want to blah, blah, blah. And well, if you're good at that, then great. You got a yacht and a private jet, and everything's good. The only thing is you're working 24 hours a day, 7 days a week without relent, and you have to be nearly perfect. Well, good luck with that for the next 20 years. So instead, what you could do is filter it out and say, well, I only want half the opportunities. What if you sold and sold and sold and sold, okay? And sold and sold and sold and sold. And you're only looking for selling opportunities. What if you only did that? And you're like, and then you could explain to me why you're a bear. And it makes sense to you. And you're like, and I do research. And I've looked at the policies of the Bank of Japan. I've looked at the economy of the Bank of Japan. I've looked at the trade flows of capital around the world. And you're like, so at some point, the bearishness is okay, but then at other points, the bearishness gets better. And over a year, you're probably more right than wrong because that's why you did the research. You following me? So, right? Down, 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 up, up. That's an easy sell. Down, 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 up, up. That's an easy sell. Down, 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 up, up. That's an easy sell. Down, 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 up, up. It's an easy sell, or you never actually got the opportunity. So this one, maybe, let's do this one. This one maybe never actually happened so that you actually didn't get the entry. Then this one, you got knocked out at break even because you had already moved your stop to break even. And therefore, you got out of this one and this one for profit. And maybe if you sold this, that one for profit. And now what are you doing? You're waiting for the next stop. So you're like, well, not now, but if this rolls over, you're going to take it down. And, okay, I would say within 6 weeks, which is a long time for someone that spends all their time on a 15-minute chart. I get that. But what if you thought through research, somewhere between the next 6 to 9 weeks, there was a high probability that this market turns bearish. And not for a day, but for like a quarter. Would you want to know that that was coming? It's like the weather. You know summer is coming. You might even know spring is coming. I don't know where you live. So you might live in Canada and you're like, yeah, it's still cold. Well, when is it going to warm up? You're like, April, May. Cool. So you adjust your behavior based on that. And that's how you should trade as well. In my humble opinion. Okay. Euro yen up, so I imagine dollar is weak again. Okay. So what was my advice to you before CPI? my advice to you was look at your bias. What is it that you want to do? So I covered this today before the news event, and I covered it last night in the day trading group. What is it that you intend to do long term? Don't worry about scalping the volatility, because vol is bad. Institutional investors spend their whole time trying to figure out how to reduce volatility. And you're trying to figure out how to pick it up. Oh, maybe I can scalp 30 pips on the news. Okay, you're not acting like a professional, but okay, maybe you can. Is it worth it? Not if your lot size is adjusted properly. Oh, but you're over leveraged. Oh, so you love vol and you love leverage. But institutional investors know leverage is bad and volatility is bad. You see that, like the weird disconnect? So instead, what I said to you before CPI is, what is it that you intend to do? Are you a buyer of this market or a seller of this market? So sellers sold high, probably around where we are now, and you just got knocked out at break even. You took a shot. Don't cry about it, okay? And bulls bought down here. Why? That's how you trade. If you look at this chart and you don't understand why that's a buy, then we need to work on your basic technical analysis. And that's okay. That's okay. But you should understand what's important on this chart is this number. Let me try to get that. Okay. And at the time, this number. Okay. You either sell high or buy low. I don't like selling high in an up market. You understand that? I know most of you do, because most of you are FX boot campers. What I prefer is to sell there. Okay? So I do not, let's do it this way. Let me change my color. Let's do purple. Purple's nice. I don't like selling here, but I love selling here or here. And you're like, but the two at the top are the same price. Uh-huh. But they're different levels of risk. VQ, Quail, you just joined FX Bootcamp? Okay, look, so the price is the same here. But that's not the point. The difference is, and at the bottom of the chart is time. The side of the chart is price. So same price, different time. So if we got a lower low and a triple top, it's not the same. It's not the same. It's lower risk. Same price, different time, especially if it made a lower low. Okay, but if we're ranging, so it did this now, let's say, and selling a triple top is because it's a range trade in a range, backed by your fundamentals. Okay, but anyways, you could have just simply had a limit order down there, boom. Richard says, I see a lot of institutions look at implied volatility. Well, it's all of that, right? So there are different ways that a bank will try to, or a different type of institutional investor will try to get rid of the volatility in their portfolio. What I'm trying to make is, the point I'm trying to make is, for some reason, amateur traders, they want the down, 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 up, 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 down, 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 up, 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 down, 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 up, 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 down, down, up, 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 and then maybe even next down, 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 up, 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 up. They want that. Okay. Vol. But also because they don't got no money but want to get rich quick, their leverage is high. And you couldn't pick a worse business model. That's the point I'm trying to make, especially to newer traders. It's dumb. Unless you got a strategy that helps you sort of lower your leverage in this environment and or lower your volatility. But then you're thinking much bigger. I'm talking to, and there may be ways to do this, but it would require, a level of sophistication, but also at the end of it, there's not a lot of money in it. So you'd have to look at lots of events that would produce this for you to make your model, how do you say, replicable enough times that you're like, well, if I get myself this time into a trade like this 1,000 times a year, and somehow through automation and other levels of sophistication of maybe, hedging and various other methods, or maybe you got options and all the whatever. If maybe it adds up to being worth something at the end of the year. But whom I'm talking to is a new trader walking into Forex, listening to a YouTube guru on how to get rich quick. The thing is, it doesn't work that way. Okay? And if you are a Forex trader driving around in a Rolls Royce that you own, it's not because you set yourself up with short-term trades, which means your timing has to be impeccable 100% of the time, with high volatility, which means in of itself, it's almost impossible to get the direction right, but you have to do it nearly 100% of the time correctly. And to make any serious money, you got to be jacked up on leverage. So anytime you're a little bit wrong, you're very, very, very wrong. And I look at it and what I'm trying to say to that person is, if you took the time to do the math, you would find out that it doesn't make any sense. So you're chasing the wrong dream. I think you can make a lot of money trading Forex. That's just not the likely, or to use more of a math term, it's not probable. You probably can't do it. But if you did, and you're like, but Wayne, look at me. I've had a great month. I'm up 40%, and all I do is, this stuff. Okay. Now, do it for 30 years straight. Forget it. You're not going to do it. There's 0% chance. There's none. You're like, but my uncle won the lottery. All right, but there was still a 0% chance your uncle was going to win the lottery, but he won the lottery. Great. You're not going to win the Forex lottery that way. Okay? There's no lottery. It's just years and years and years of hard work. And the only way to get consistent returns is reduce volatility and reduce leverage. Increase your consistency over long periods of time. And that does work. It does work. Okay? Cool. Okay. Now, let's look at this chart. Richard says, increase that Sharpe ratio. Well, yeah. You will not attract investment with a poor Sharpe ratio. unless the investor is stupid. Because a Sharpe ratio just simply measures the return you got for the risk you took. So why would you invest in somebody who's profitable, but not profitable enough to compensate you for the risk? Okay, for example, if an Argentina bond sorry, I can't even follow what I can't even think it right. Argentina, sorry, sorry. I apologize to my Argentine friends. I can't think and spell it. Argentina. Anyways, all right. Let's say right now, if you bought an Argentina bond for 20%, okay, you can buy it right now and they pay you 20%. Currently, so let's say it's a 10-year, currently in the United States of America, which is easier to spell, Argentina is not hard to spell either, is 3.65. Okay. Now, so you should buy the Argentina bond, correct? Okay. Not if there's 50% inflation. So an amateur investor would only look at the 20% and say, oh my God, that's an amazing deal. If I loan money to Argentina, I'm going to be rich. I'm just going to, right? Money is going to rain out of the sky, guaranteed 20% a year. You're like, oh my God. Compounding. So let's say you take that and buy another bond and then take that and buy another bond. In 4 years, you'll double your money. And then you're like, and then I'll add that, and in 8 years, you'll double your money again. And oh my God, you're just going to be filthy, stinking rich. Now, if you adjusted it for risk, in this case, it's inflation risk, you're actually a loser. And that's the difference. So you might make money, as Richard says, but the Sharpe ratio, as Richard says, is important. And what it does is it takes your absolute return. So you're like, look, Wayne, I made $1 million trading last year. And I look at your Sharpe ratio. I might say, well, the risks you took to make the $1 million, you should have made $2 million just to compensate for the risk. And really, if I was going to invest for the risk you're taking, really, for me to get involved, you got to compensate me, not just get me back to break even risk adjusted. So like you should have made $3 million. So congratulations on your $1 million profit. But an institutional investor would say, congratulations on your $1 million in profit. We're not interested, not even remotely. In fact, take your $1 million in profit and please leave and don't come back. Oh, but if the Sharpe ratio says your $1 million was pretty good, in fact, quite good for the risk you took. You had very low volatility. You had very consistent returns. And you actually had alpha. You produced something more than the risk. You just somehow did really well. You would have a good Sharpe ratio. You're like, yeah, I got a 1.9. 1.9. But it was only $1 million. Oh, okay. Well, what is it that you're doing? Because we want to know if it can scale. You get a question like that, Winner, winner, chicken dinner. They're going to invest. And you're like, but the absolute return is the same $1 million. Yeah, but one undercompensated for risk and one overperformed relative to risk. And that's called alpha. And that's where you want to go, guys. And you're not going to get that scalping because you're seeking volatility when the entire institutional market is trying to avoid it. So I'm just like, you got to get there someday. And you know what can happen is you can sit here and say, I want to trade like that one day. 5 years goes by and you're still trading like retail. And you don't have a track record of low volatility. Oh, well, now you got to go another 5 years and you just never get there. Find out you're walking in circles, right? Anyways. Take a look at some commodities. Okay. Little tiny move here on gold, still working out. S&P 500 now deciding not to be so happy. That makes more sense to me. Bitcoin, again, a canary in the coal mine. Very negative, pulled all the way back. You know, should you sell? Like, my thought, if you're bearish and you look at everything, you're like, okay, you think what? Metals are going to come down, oil is going to come down, the stock market's coming down. What you do with Bitcoin? Okay, you have this amount of risk because you wouldn't sell higher than that, and you're already here. So this is your selling box. If you were going to sell, you would tune into that box. You know what I'm talking about? Here's a new trade for me. I'm doing palladium. Palladium went all the way up and then came all the way back around. I'll adjust my stop a little bit here. Okay, I'm trying to keep it in there. Okay, you can see the spread's a little wide on the volatility, but it came up and then it went down and then we're kind of back to where we were. Now, the interesting thing with this, and we'll just take a look. I'm experimenting, if you will. This is what, either you have a demo account or you have, what I call a coaching account. You have a small account for improving. That's what most people think it's just for trading. No, you should have an account for learning, experimentation. Okay. Now, what I'm kind of looking at here. Hey, where's my peso trade? Oh, did I get knocked out on my peso trade? No way! Oh, dang it! Okay, that threw me off. So I was on peso. Shoot. I'll have to take a look at what happened. But anyways, what I was trying to do is look at gold, look at palladium, for example, and using them as hedges. So look, this is all redundant. See, I'm buying dollar across the board, making money across the board. That's not actually what I want to do. So I'll probably have to, what I wanted to do, and I'll probably have to get rid of this. It's just too much of the same thing. But what I was doing was essentially trying to find a hedge on my Mexican peso trade, which for some reason I'm not in. I don't know. I must have mismanaged it. Maybe Raymond made me move my stop. Thanks, Raymond. Yeah. Anyways, So I'll have to go back and figure out what happened there. Obviously, I'm in the middle of coaching, so I don't know. But the idea was if I'm short dollar but long peso, then I got to hedge my short dollar with a long dollar, and ideally something with a similar tick value and not an expensive carrying cost. Okay? And so that's why I'm playing around with some of these things. So Palladium is paying $1.44 a day. Okay. Right? $1.44 a day. Boo, boo, boo. It's funny, I have to use my phone calculator because my Windows calculator doesn't work. What? It's $1 trillion company and its calculator doesn't work? Anyways, so 365 times $1.44 is $525 a year. I think it's about $250 margin. Okay. So let's call that 200% a year. Palladium pays 200% a year at tradersway.com in swap. So now I'm finding there's a lot of volatility in Palladium, and apparently Palladium is expensive. So it may not be the right hedge. It might just be gold. But nonetheless, my thought process is if I'm short Palladium, which means I'm long dollar, but then I'm long Mexican peso, which means I'm short dollar, then I'm hedged on the dollar, but I'm being paid on both positions. Both trades are paying me positive swap. So I'm making 400% a year on peso, and I'm making only 200% a year on Palladium, and trying to get my dollar risk to zero. Now, why would somebody spend time trying to figure that out? Well, I don't think I have it on Palladium, so I don't know if I'll keep doing it. But the idea is, can I lower the volatility and still eke out a consistent return? And instead of being leveraged 100 to 1, instead of being leveraged 50 to 1, what if I was leveraged 10 to 1? Okay? And only produced while being market neutral, or let's say dollar neutral. What if I got it so that I only made 25% a year? Well, on a $30,000 account, you're like, dude, that's chump change. But what if it was a $30 million account? And you showed to an institutional investor that you're essentially market neutral using some leverage and producing 25% a year with extremely low risk and extreme consistency. Your Sharp would be wonderful. Your return, dude, that's more than enough for institutional investors. All of a sudden, you're the most interesting person alive. Okay. Yeah, so on is, asking all the right questions. Well, what if the correlations will be negative and you'll get negative on both? Well, that's what you're trying to avoid, right? So you want to get proper tick values, average daily ranges. You want to at least, if you don't have positive carry or swap on both, then you need one to be high and one to be low or lowish. And then you need correlation. So you would want to look at the current correlation between them, but then you might want to look at seasonal correlations to know when the hedges are going to perform and when they're not going to perform. And then, of course, if the central banks change their policies, that could change the appreciation. But, this is where I think at the end of the year you would work this out and you'd get better at it. And that's why, look, we all need hobbies. I'm trying to try new things. I like what I like, but I also want to learn, right? And so over the course of the year, you can get better at it. But I think ultimately the nice little sweet bonus is, yes, what if you could just pick up that swap with a little bit of leverage and it's enough income to produce enough return so that you can get investment, which is a way to increase your AUM, your assets under management. So you earn a little fee for all that. But the sweetness is if you know when to do it properly with seasonality, you might have a better notion of when you don't need to hedge as much. And now, why would you do that? Well, first, it lowers your costs, maybe, right? But you might be able to add some alpha of knowing when to remove the hedge so you can make money on the pips. And then when that kind of runs its course, then you re-engage the hedge so that at the end of the year, you got your sweet swap. But now there's actually pips left over, right on? So you're like, yeah, we only made 25,000 pips this year, but it was a tough year and we had to maintain our hedges more. And, the pips are worth a gajillion more than the swap. And that would, that would be an interesting number. So anyways, whatever. So on exactly right questions, and that's what you want to figure out. My point again here is, even in my experimentation, I'm trying to find even better ways to reduce my risk, to reduce my volatility, and to produce consistent returns. Right? And that's the message. All right, to my day trading group, you're probably going to get an email reminder that to log in to our meeting at 4. But as I expressed in the last few days, I have a family engagement, and I may not be able to get back in time. I might be able to, but don't count on it. And I can't cancel it, because then if I cancel it, the whole machine breaks down. So you probably get a reminder to log in, then you'll log in, you're like, oh, dang it, nobody's here. Well, I apologize, but I probably won't be around tonight, so don't plan on that. Okay? So peace on earth, may the pips be with you, may your profits be above average.